The best part about being a rental property owner is the passive income you can earn from the cash flow coming in from your tenants. But if you aren't taking advantage of rental property tax deductions and write-offs, as a property owner, you are seriously missing out. There are a lot of ways to increase your income without Uncle Sam taking it all away. So in this video, we have 10 rental property tax deductions you must know to generate the most income possible as a landlord. In return, take a few seconds and subscribe to the channel because we post videos every week to help you level up your journey in real estate investing and owning rental properties. So don't forget to ring the bell so you never miss out. Now, yes, owning a rental property can be a great source of extra income, but it also comes with a lot of hard work. I mean, starting from mortgage interest to repairs and maintenance, the expenses can seem endless. So if you're looking for a way to save money through your rental property, claiming rental property tax deductions is the way to go. Understand that the tax benefits of rental properties are enormous, but a majority of landlords are unaware of these benefits and end up paying more tax than they should on their rental income. So if you're a landlord looking for a way out of your tax woes, here's a list of 10 rental property tax deductions that can help you out. Familiarize yourself with these to help reduce your tax burden to the IRS. Number 1, depreciation. Who would have thought the depreciation of your property could save you money? To take full advantage of this, you need to think of your rental property as a business asset that loses its worth over time. Understandably, the math isn't simple, but if you deduct the depreciation of your property each year on your tax return, you will be avoiding a lot of unnecessary payments. And to avoid any hassles, it's a good idea to seek the help of a qualified professional to get the calculations correct. Depreciation is one of the biggest and most important deductions for rental property owners because it reduces taxable income without impacting actual cash flow for your real estate. Since land cannot be depreciated, the preferred strategy is to allocate as much of the property's purchase price to the building as possible to maximize your depreciation expense. Number 2, transportation and travel. Did you ever have to drive to your rental building to deal with a tenant's complaint? Or maybe you went to a store to get something from your rental property repaired. The good news is you can get a rent tax deduction on all this rental activity related to travel. All you have to do is add these expenses to the property's tax basis and depreciate them over the years to come. As for the vehicle that you use for these trips, you can either use the standard mileage rate according to the IRS or subtract your actual costs. However, if you make overnight trips for your rental activity, make sure to document all your expenses as the IRS may closely scrutinize rent tax deductions from your overnight travel. Now, obviously, it's common for landlords to travel to rental properties located within driving distance. You might also have to travel to the bank, the hardware store, or to meet with your broker, your attorney, and other key partners and suppliers. If you have an official home office and plan to take a tax deduction for local transportation, it's important to keep a log or use software to properly track all miles driven for business purposes. The standard mileage rate was 56 cents per mile for 2021, so use that as a baseline for the upcoming tax filing. Number 3, repairs and maintenance. Repairs and improvements to your rental property are the heart and soul of your life as a property owner. If you haven't already known, you can deduct the cost of repairs you make on your rental property from your taxes. As a rental property owner, it is important that you know the difference between repair and improvement. It's more beneficial to incur expenses on repairs than improvements. If you spend money on improvement, you are making an asset better than it was before. You are either upgrading or replacing things. Repairing, on the other hand, does not make an asset better than it was before. With repairs, you either patch or mend things. The best way to get rent tax deductions is to repair your damaged assets. Instead of replacing broken items, you'll get the best tax result if you patch, mend, or fix them. When you incur repair and maintenance or renovation expenses, you'll want to classify as much as possible as standard repairs and maintenance to deduct them in the year incurred. More significant projects that qualify as capital improvements are depreciated over several years, which reduces the value of your current year deduction. The best practice here is to have all of your renovation, repair, and maintenance invoices and receipts itemized by each vendor. Number 4, employees and independent contractors. Now, money paid to W-2 employees and independent contractors to help run your rental property business are fully tax deductible on Schedule E of your tax return. You're required to send and file 1099s for any independent contractor you pay more than $600 during the calendar year. This will be if you're a real estate professional for tax purposes, you provide substantial services to your short-term guests, you're considering the 20% QBI pass-through deduction. Keep all of that in mind when writing off tax deductions for employees and independent contractors. Number 5, professional fees. You will most likely have to hire professionals to assist you with your work, and these services do come at a cost. Thankfully, the cost of hiring these professionals is deductible. This includes paying a lawyer for advice or assistance, as well as the cost of hiring an accountant to help you with your finances. Even if you file your taxes using automated software, you can deduct any fees you pay for that service. Professional fees, including legal, accounting, property management fees, and business expenses related to your rental properties, are fully deductible and reported directly on IRS Form Schedule E of your tax return, so make sure you are taking advantage of these, especially if you are paying high prices for work that you outsource. Number 6, interest. You must be wondering where interest comes into play in rental property tax deductions. Did you know that interest is the biggest deductible expense for a property manager? In fact, if you borrow money for any business activity, you can deduct your interest on that as well. As a property owner, you can get a rent tax deduction on your interest payments in a variety of different ways. If you've taken a loan to buy or improve your rental property, you can deduct your mortgage interest on that loan. Did you use your credit card to purchase goods and services for your rental property? You can even get rid of your credit card interest too. Even personal loans you've taken out to pay for items for your rental property are interest deductible. Now, interest on loans used to fund your rental property business, including mortgage interest, interest from a home equity line of credit used within your rental business, and any other interest is fully deductible on Schedule E of your tax return. This is an important distinction for pure rental properties because interest is only deductible on up to $750,000 of principal for primary and secondary residences. Number 7, taxes and insurance. All taxes, with the exception of income taxes incurred as a result of owning a rental property, are deductible on Schedule E. These typically include property taxes, school district taxes, and special easements or land taxes. Unlike your primary residence, there is no cap on the amount of property tax expense that can be deducted on properties held for investment purposes. Insurance, including homeowners, hazard, liability, and flood insurance, are fully deductible on Schedule E of your tax return, so make sure to get in touch with each one of your lenders to get the proper numbers filled out on your Schedule E once you get started. Number 8, education. Education expenses are tax deductible when incurred for the purpose of maintaining or improving the skills needed in your rental property business. These expenses are only deductible when incurred after you start your rental property business. For example, you can deduct the amount spent to attend a property management training program and related travel costs only if you already have an existing rental property business. If you have yet to purchase and place your first rental property in service, then these training expenses are not deductible. Notably, training costs for courses to start a new business such as a fix and flip maybe, these are generally not deductible since it's considered a new skill set and does not maintain or improve the skills used in your existing rental property business. Number 9, miscellaneous expenses. Expenses such as HOA fees, bank fees, subscriptions, meals, and other miscellaneous expenses related to your rental business are also deductible on IRS Schedule E. If you've been around real estate long enough, then you'll know there are several hidden expenses that rarely anyone talks about because they're so busy focused on the other large headaches that they have to deal with. But when you look at the bigger picture and you start to break down all the miscellaneous expenses to show up throughout the year, you'll be able to directly report that as tax write-offs. You just have to make sure you keep track of them all throughout the year, and that's why it's highly recommended that you use an online tool or software that not only keeps track of receipts, but can also keep everything organized and separate from each other so there is less scrambling once tax time comes around. Now, these deductions are not as common, but they're becoming more popular among rental property owners. Number 10, 1031 exchanges. Some other tax deductions you can use are 1031 exchanges. This allows you to defer both the capital gains tax and depreciation capture from the sale of a property and invest the proceeds into another like-minded property, often called trading up, while you ultimately have to pay tax at some point down the line. With the notable exception of inheritance, this allows you to use the entire proceeds to purchase a new property. You can thereby increase the size of your portfolio at a faster pace than would otherwise be possible if you are paying capital gains taxes upon each sale. 1031 exchanges have a very strict timeline that needs to be followed and generally require the assistance of a qualified CPA. Double check with your state guidelines so you can handle these tax write-offs appropriately, because there are some exceptions when it comes to each state. Now let us know in the comments, have you been missing out on these tax deductions as a landlord? I'd love to get your feedback on this topic, and just let us know exactly what you think about all of this. So we hope you found this video helpful. If so, take a few seconds and drop a like down below for the video, and don't forget to subscribe to the channel for more powerful real estate content. Also, if you really want to take advantage of the benefits that come with owning rental properties, check out this playlist we created where you'll get a complete breakdown of how to get started becoming a landlord, so you'll definitely want to check those out as well. And until next time, we'll see you guys in the next video.